Get unlimited access to all of our CPE courses at www.teachucomp.com/unlimited CPE.
In this lesson, we'll take a look at insolvency. An individual is considered insolvent when his or her liabilities or debts are more than the fair market value of his or her assets immediately before the cancellation of debt. In order to determine insolvency, a taxpayer should include all assets as well as the collateral value of everything he or she owns. Liabilities include the entire amount of recourse debt, as well as the amount of non-recourse debt that is not in excess of the fair market value of the property. In any insolvency situation, and regardless of whether or not the taxpayer ends up having to pay the debts, the insolvency must be reported to the IRS. If the amount of insolvency is more than the amount of canceled debt, no canceled debt will be included in taxable income. Let's look at an example. John had a credit card debt of $10,000 forgiven after he worked out a deal with the credit card company. Immediately before the cancellation, John found that his total assets equaled $20,000 and his total liabilities equaled $40,000. So John was insolvent $20,000. Since this amount is greater than John's forgiven credit card debt, he does not have to include the forgiven $10,000 in his taxable income. However, John must still report this amount to the IRS using Form 982. If the amount of insolvency is less than the canceled debt, some of the canceled debt may have to be included in income if no other exclusions or exceptions apply. Let's assume the same facts that we used in the previous example, only this time let's say John's assets equaled $20,000 and his liabilities equaled $25,000, making John insolvent $5,000. This would mean that John would have to include the remaining $5,000 from the canceled debt in his taxable income.
Like what you see? Get unlimited access to all of our CPE courses at www.teachucomp.com/unlimited CPE.